All right. Before we go into the dashboard, we need to understand why we always talk about gamma. Why are we talking about option Greeks? Why are we talking about gamma? And basically, why is that important for any trader? So when we look at option positions, we're going to talk about Greeks. We're going to talk about gamma, delta, theta, and others. So the answer is that you don't need to really be an option expert to be able to use this tool. But you need to understand why gamma is so important, right? Because gamma is really the hidden force behind price movement. So for those who don't know what gamma is a second derivative of delta. Gamma measures how fast delta changes throughout the day. And basically, delta measures how much of an option moves based on the underlying price. Gamma, on the other hand, measures how fast delta moves as the price of the underlying changes. So in simplicity, when we are in a higher gamma regime, there is more sensitivity and market makers need to hedge faster. So we're going to see a lot of price swings, right? So understanding gamma, very, very important. Here, again, why is this key? Because behind every option positioning, there's going to be some hedging going on coming from the market makers. So we need to understand that option flows create futures flows. So most of the hedges is done through buying or selling futures, but also buying or selling the underlying. So this slide shows you really quickly what does it mean if we are buying a call and what's on the other side. So if we are buying a call, on the other side, we're going to have a market maker that is going to be on the opposite side of the trade. They're going to be short the call, and in order to hedge, they will need to buy the underlying based on the delta of the option. So the higher the delta, the more hedging activity we're going to see. And again, when delta changes fast, especially during zero-ETs calls or zero-ETs put options, we're going to see a lot of movement throughout the day. So take a screenshot, take a look at this slide, because this is very, very important. Why is this important even if you don't trade options? Because you need to understand that behind each move, we are going to see the hedging activity of the market makers that are actually buying or selling the underlying based on how much option positioning we have in the market. This brings us to the power of this chart, right? This is one of the main charts that we see. We're going to go and show you in the dashboard. This is our net JAX chart, and net JAX stand for net gamma exposure chart. So this chart shows you green bars and red bars. Green bars is positive gamma. That means that there is more stability in the market. Red bars are negative gamma. So those could be potential volatility zones. We use this daily to map out likely support and resistance levels that are not visible on the price chart. And we're going to show you some examples. So for example, let's say that we are in a negative net JAX, right? Let's say that we have a really strong negative net JAX. That becomes a hot zone. So that becomes an area where price could reach that area, and then again we could reverse on that area, but we could also break through. So if we break through that area, we're going to see a very, very strong volatility. In this chart, we can also map, and this is highlighted with the arrows, we can map our put support level, which is at the bottom left, the widest red bar. We can map our core resistance or call wall at the top right, which is the largest green bar. And then we can map our gamma flip level, which is the high vol level, which you see in the white circle here, which is the level where we are flipping from positive to negative gamma. And that brings us to the next slide. And why is this so important, right? Because we need to understand also as retail traders that if we are in a positive gamma environment, we can expect a certain outcome. If we are in a negative gamma environment, we can also expect a different outcome. So when we are in positive gamma, what does positive gamma mean? It means that the market overall is long gamma. It means that they're buying more option than selling. When the market buys more option than selling, on the other hand, the market makers are hedging in a different way from a negative gamma environment. So the market makers are going long when the price goes down and are going short when the price goes up. As a result, this tends to stabilize the market. We're going to see low volatility during like a positive gamma environment, and that's good for the market, let's say. When we are in a negative gamma environment, on the other hand, the market is short gamma. So they are like basically selling more option than buying. So when they do that, the market makers are also basically hedging differently. They're going short when the price goes down, and they're going long when the price goes up. So as you can imagine, this way of hedging is actually going to bring volatility up. So we're going to see a larger volatility, a higher volatility. That doesn't mean that if we're in negative gamma, the price is just going to drop. It means that we're going to see sudden shift in the market to the upside or to the downside. So why is this important? Because if you're trading, for example, NQ futures, and we are in a negative gamma environment, and you typically have a 20-point stop loss, if we are in a negative gamma environment, most likely you're going to be chopped out very fast because of the way the market structure is formed. So because we are in a very volatile environment, again, you might want to readjust your position sizing. You might want to readjust your stop loss, your take profit target, and just by knowing this can really help you.